The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Wait and see. After 3 straight meetings of rate cuts, the Fed hits the pause button. Live from Studio 2 here at Bloomberg World Headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're just about 10 minutes to the closing bell. We had this Fed meeting where it seemed like, as you mentioned, wait and see was like the phrase that he turned to most often, along with, I'm just not going to comment on that.
Yeah, and you see that reflected in the moves, particularly down at the bottom of your screen, 4.5526 on a 10-year yield. That's up, Scarlett.
Barely.
2 basis points, but we should point out, up 2 basis points on the day, but that's still lower than where we were just last Friday. So coming into the week, expectations, at least on the moves in rates, now slightly to the downside.
And of course, we're awaiting earnings after the closing bell. This will be the real driver going forward here because Chair Powell wasn't able to say very much given that not a lot has happened on the tariff front. And right now, there's a lot of rhetoric, but not a lot of action. All right, so the big gainers here.
Heaviest, we talk about the gains on screen, though, or the moves, I should say, on the screen, though. When we take a look at just how much this is going to actually matter to the markets, much more so than Jay Powell. Microsoft, Meta, Tesla's 3 of the 10 biggest weightings in the S&P 500. And of course, all 3 are going to report earnings after the bell, as is IBM.
You know who the best performer is among that bunch over the past couple of months?
Yes. Who?
Meta.
Yeah, that's right.
Up 15% so far this year at a record high. Biggest gain among Mag 7 names since the last earnings, up about 14%. It's all in on the Llama AI model. And of course, it's because it's open source, it's seen as beneficiary.
And of course, some of the numbers may matter a little bit less than some of the commentary, of course, around DeepSeek and the future of AI. A lot has changed. A lot has changed over the last 72 hours when it comes to those names. We'll have full coverage better than anyone else as soon as those earnings cross the wire after the bell. But let's go back to what happened just a couple hours ago at 2 p.m. at 2:30 and Fed Chair Jay Powell.
Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. Longer-term inflation expectations appear to remain well anchored. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. Right now, we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place, actually.
Jay Powell, of course, a master of, well, kind of saying nothing, giving the markets, I guess, what they expected to hear. Well, Betsy Duke joins us right now. She is a former Fed governor. She's also the former chair of Wells Fargo. She joins us right now to give us her take, I guess, on what we learned. And Betsy, did we actually learn anything today?
No, it's really hard to do, I think, a press conference, probably for the chairman and for the reporters in the room, when there's nothing to say. And so the reporters keep asking the same questions over and over, trying to get something said. And the chairman kept saying nothing.
Well, and as far as those reporters asking the same question over and over, it seemed the one theme coming out of those reporters' mouths wasn't about monetary policy directly. It was about White House policy, question that Jay Powell dodged again and again and again.
And will continue to dodge. I think this is the first of several press conferences where you'll see basically the same thing. It's hard to imagine that there's going to be definitive moves, several readings on inflation that would indicate the Fed should move one way or the other in the next couple of months. And it's going to take that amount of time for the administration policy to first get fully articulated and implemented, and then to determine what the effect of it's going to be. So I think it's going to be hard to have anything definitive coming out in terms of what the Fed sees where it's likely to be until sometime around the June meeting.
One thing that has been definitive, Betsy, is President Trump repeatedly calling for lower rates, saying that he's better than Jay Powell in judging where rates should be. Does this create problems for Jay Powell for the FOMC?
I don't think so. I think he's made it pretty clear, and I think that's been true for chairman before Jay, and I think Jay believes it absolutely that the independence of the Fed is the key to its effectiveness. And so I think you will continue to see him not comment about it and certainly not be changed by what that commentary is. The second thing is it's hard for the president to impact the work of the entire committee. So what you see is what Jay Powell says, but Jay is speaking for a committee that's really 19 individuals and 12 voting members.
Right. And of course, there was a change in the slate of voting members for 2025 as well. So while we don't have any clarity on tariffs, we do have clarity in terms of some executive actions, the freezing of billions of dollars of federal loans and grants, increased deportations of immigrants, plans to gut the federal workforce. How do you think about the degree and the ways in which this will show up in the economy, specifically the labor market?
It's kind of hard to see with some of those executive actions because they're going to have to work their way through the courts as well. So it's really hard to see that. I think we'll begin to see the first policy we'll begin to see impact from is this idea of deportation. And it'll show up not just in who's being deported, but how does that affect immigrants' willingness to show up to work to various workplaces?
Well, this gets to this idea, though, Betsy, and I think it was kind of interesting. During the Fed special that was on right before us, Jeffrey Rosenberg talked about this idea of how we kind of went from a Fed that was kind of forecast dependent to one that was data dependent, and now, at least in his words, one that kind of has to be White House policy dependent. And I know there's really no incentive for Jay Powell to go out on a limb right now and talk about these things, but surely no one inside the FOMC right now is thinking about making policy decisions without a close eye on what's coming out of the White House and maybe potentially Congress.
I don't think anybody anywhere would argue with the fact that this is going to be a very impactful presidency and it's going to move fast with very dramatic actions. The question is going to be, in what direction are they? How much will they be slowed or impeded by either working through the court system or issues related to Congress? And so it's going to take some time to see what the policies are, how they stick, and how quickly they get implemented. Right. But there's no doubt that it's going to be the major factor on the economy for certainly the next year.
Betsy, very quickly, I have a question for you on banking. With the Fed on pause until at least mid-June, how much should investors reassess the outlook, the impact on bank earnings? You look at Lending Club, the shares are plunging on disappointment over loan origination guidance, and the CEO talked about how that's because the timeline for rate cuts are being pushed out. Does this extend to the whole sector?
I don't think so. I think when rates are stable, that's really good for the banking sector, which is the sector I know best. So I think that's fine. In terms of the mortgage market, I think the mortgage market is going to have to, and it will do so slowly, adjust to where the level of mortgage rates are. Betsy
Duke, former Fed governor, former Wells Fargo chair, we thank her for her time as we count you down to the closing bells. A look back, of course, at the big Fed meeting, at the press conference, and now we'll push ahead to a big slate of earnings set to drop in just a few minutes.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu taking you to the closing bells, a global simulcast. It starts right now. Carol Massar and Tim Stenovic in the radio booth, and we're joined here in the TV studio by Caroline Hyde, the co-host of Bloomberg Technology. And it is going to be all about technology. Meta, Microsoft, Tesla set to report earnings in just a few moments' time. IBM, Lam Research, ServiceNow, further down the market cap spectrum. The big market moves just up ahead. Carol, what do you keep an eye on?
Well, how quickly our focus changes from one big thing like that Fed decision and Fed press conference, right? And I feel like, okay, market's kind of in a cool space that they're kind of where they were before the Fed decision. Having said that, you are right, Romaine. It's all about what we get from these big tech companies. And in particular, that AI spend, there's going to be a lot of questions on that front, considering the news this week.
Yeah, and look, Bloomberg News reporting earlier today that Trump administration officials are considering expanding those restrictions on NVIDIA chip sales. We saw the entire market move as a result of that, and NVIDIA fall close to 7% as a result of that. This is on everybody's mind right now, especially on those investors who are watching these companies report today. A lot of questions about CapEx, I'm sure.
Yeah, but I wonder how much a stock like Tesla is really going to move on the results, because it's so far divorced, the share price action, from the number of cars it actually sells these days, right? I mean, it's all about Elon Musk and his political influence at this point.
has it become a meme stock trade? And how long has it been the case? Ultimately, I think what's going to be really interesting is what dictates trade, whether it's more of a Microsoft and the heavy market capitalization, whether it's Meta and the ripple effects across other social media related stocks. But remember, he just said 65 billion. He's going to stick to it.
All right, Tesla down here in the cash session, down about 2%. Apple and Meta, the only two of the Mag 7 stocks in the green as we await those earnings. Red across the screen on the headline indices, the Dow down 0.3%, an S&P down 0.5%, the NASDAQ composite down 0.5% as well. The NASDAQ 100 down 0.2%, and the Russell 2000, Carol, down 0.2%.
Indeed. And as I said, I really do think it's important that, we went through some kind of roundabout moves coming off of the Fed decision, the Fed presser, but again, kind of finishing the day where we started just before that Fed decision.
Okay, a quick glance at how the sectors performed on the day. You have 7 sectors in the red, real estate investment trusts and tech each down by at least 1%. On the flip side, communication service, staples and utilities are higher.
All right, let's get to some of the individual gainers as we wait a big bunch of earnings. I got a tech one for you guys. ASML Holdings, this is a top gainer in the NASDAQ 100, up about 4% here, surging the most since 2020 over in Amsterdam.
All right, I'm going to interrupt you.
Yeah,
Microsoft earnings crossing the wire right now. On the top line, revenue $69.6 billion. Street looking for 68.9. Cloud revenue at 40.9. Street looking for 41.8. We should also point out EPS coming in at $3.23 a share on the Azure side. We're looking at that and cloud revenue services here. Revenue ex-FCX up about 31%. Caroline, excuse me. Going to get these two confused today. What jumps out at you?
The comments coming from Satya. We are innovating across our tech stack, helping customers unlock the full ROI of AI. We want to hear the return on investment because that is where we're questioning. As you're not growing as quickly as had been anticipated, slightly dialing back from the previous quarter, this is where they offer their OpenAI integrated services, Tim. And we are seeing at the moment, hearing them speaking the lingo. They talk about their balancing operational discipline with continued investments in our cloud and AI infrastructure. I wonder if they put disciplined in that sort of marketing speak quite recently.
No, shares down right now by about 4%. Worth repeating some of these headlines. Second quarter revenue coming in above estimates, or we could say meeting estimates, $69.6 billion, estimates for $68.92 billion. Second quarter Azure revenue coming in just shy of estimates at 31%. Second quarter cloud revenue missing estimates. That seems to be what investors not so happy about.
Yeah, I guess the big question here is we know that they've already committed about $80 billion in CapEx for this fiscal year. The question is how it's going to allocate that spending, whether it's going to continue being on hardware or, as some analysts suggest, maybe to inference workloads, given the success of the Chinese startup DeepSeek.
All right, again, we're continuing to see Microsoft in terms of the after hours here, down about 5.25%. And again, I'm going to go through the big AI spend and what we get. Azure, as you said, second quarter Azure revenue up 31%. That's just about in line, maybe a hair lighter than what the street was expecting. Also, another headline from Microsoft saying AI surpassed annual revenue run rate of about $13 billion. But it's going to be a lot of questions about AI, certainly on the call today.
That was 175% year on year. It just speaks to how far we've come, but how much is already priced into a company like Microsoft, how much we're looking at the underlying earnings growth and whether it can be vindicated if OpenAI, though, suddenly starts to become forced to become cheaper and cheaper. Actually, that's going to speak to Microsoft's business model in the longer term. If generative AI has to rush to the bottom in terms of pricing, well, suddenly a business model becomes clear if they're able to arguably price it at a lower point to us and sell yet further and further products.
And the question is, how comfortable are investors going to be with that spend as we keep an eye on Microsoft and their earnings? Western Digital, of course, big memory maker, moving lower in the after hours trade, a beat on several key metrics here, but weakness on the gross margin level. And it kind of puts us into perspective here what is right now going to be a broader conversation about spending in the tech space, spending that we should point out, at least I thought, investors were already somewhat uncomfortable with heading into this week.
We thought they were uncomfortable, and then we saw what Meta stock did on Friday after that announcement from Mark Zuckerberg. Did everything change on Monday when the market finally reacted to DeepSeek? I mean, we knew about DeepSeek last week. We knew about DeepSeek weeks ago. We didn't know about R1. That was recent. But this shouldn't be news to the folks at these companies.
One thing we should mention, Amazon, which does not report earnings today, is following Microsoft shares lower. And of course, Amazon, a big player here in the cloud space as well. Tesla earnings have just crossed, so let's get to that. Tesla saying that fourth quarter adjusted EPS was 73 cents. The consensus estimate was for 75 cents. And there's a headline here as well that there was less cost reduction than previously expected. Once again, fourth quarter EPS trailing the consensus estimates by 2 cents and less cost reduction than previously expected. Revenue, $25.71 billion. That is shy of the consensus estimate of $27.2 billion. And free cash flow, Caroline, $2.03 billion. Analysts were looking for $1.75 billion. But does this matter at the end of the day for the stock?
Well, does less cost reduction speak to a lack of efficiency that's going on from the man who's helming efficiency? I say that with a host of irony. But look, this is
my first thought.
Well, I mean, there is an element here that this is a company that we knew was seeing difficult deliveries in the fourth quarter. It underwhelmed, and still the market went up and to the right in its share price. People don't care about ultimately the fundamentals, so we'll have to see how the market is reacting. We're dropping by 3% after the fourth quarter adjusted earnings per share did miss. They expect Cybertruck eligible for an IRA consumer lift there. So interesting that they're still talking about tax credits coming for certain of their cars when this is something that's clearly being talked about with the now Trump presidency. Achieved record deliveries in China, and China's going to be a key point, Romain.
And I just want to point out, too, gross margins coming in slightly below estimates, 16.3% versus 18.9%. And that operating income number, which we should put into perspective here, $1.58 billion. The street was looking for $2.68 billion. So a big miss on the bottom line, Carol.
Yeah, no, and another headline, the Cybercab scheduled volume production starting in 2026. Remember, earlier today on X, they talked a little bit about autonomous vehicles navigating from the factory to designated loading dock lanes without human involvement. They said one step closer to large-scale, unsupervised, full-scale driving or full FSD. And so there's a lot of things that are at play here that people want to know about: new products, new developments, what continues to kind of move the revenue line and the revenue growth line.
Well, the folks who are bullish on Tesla think that full self-driving will be a key part of that. The company's saying that this year will be seminal in Tesla's history as supervised full self-driving continues to rapidly improve with the aim of ultimately exceeding human levels of safety. It'll eventually unlock an unsupervised FSD option for our customers and the robo-taxi business, which we expect to begin launching later this year in parts of the U.S. The big question is, what do federal regulations look like around that? And where and when can Tesla actually do this?
All right, Tesla down about 5% here in the aftermarket. Microsoft also, it is down about 3.5%. Lam Research just out with some results, and it's up almost 5% in the aftermarket. So a lot of earnings coming here. All right, guys, that's going to do it. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Continue to watch us across the board, because we're going to continue to break down these earnings as they continue to come out.
And our deeper dive into those earnings continues here in the after-hours session. Your big movers to the upside, Lam Research and Las Vegas Sands on earnings beat. But to the downside, two of the most consequential companies in the market right now, Microsoft and Tesla, both moving lower. Caroline Hyde, the host of Bloomberg Technology, sticking with us here to help break down those earnings. And Caroline, let's go back to Microsoft, and what now is a big miss on cloud revenue and a big drop in the shares.
And a slowdown. We're getting clarity from Amy Hood, the CFO, and overall executives that Microsoft AI did add 13 points to Azure revenue growth. And that was versus 12 points quarter on quarter. They're trying to talk about how AI is still spinning the wheels for them overall, but Azure just isn't firing on as many cylinders had been anticipated. We're seeing, 31% growth overall. That is a slight slowdown. So is it that the overall offerings, the co-pilots, the chatbots that they're offering aren't selling as quickly as possible? And indeed, you're going to be speaking to software with IBM, Romain.
Yeah, absolutely. A lot of other earnings coming out, including we're looking for Meta, IBM now crossing the wire. Revenue in the most recent quarter, $17.5 billion, pretty much on the nose of what the street was looking for. The company also saying free cash flow coming in above estimates at about $6.16 billion. Software revenue on the nose at about $7.9 billion. And well, here's your commentary on AI. IBM saying that its generative AI book of business now stands, Scarlett, at more than $5 billion.
Okay, this is the number that everyone's been watching for, and the software business is really the part that people are excited about. It's seen growing after 3 straight quarters of growth, and of course, it has some of that Gen AI as well. Are there any signs, Caroline, that Gen AI bookings are in software? Because so far it's been the consulting part of the business, and that's the part that has seen a little bit of a speed bump.
Yeah, we've been worried about businesses' ability to be spending further and further on IT, but it looks as though actually fourth quarter consulting revenue came in at 5.18. That's just slightly shy of expectations. But the fact that the book of business that they're managing to say is $5 billion, look, our Bloomberg intelligence team had thought it would be signaled more at a $4 billion level. They're really trying to signal out that this is their winning formula. Software had been what had sold the share price last year, and they'd really outperformed best share price for IBM in terms of gains since 2009, but now managing to show that the consulting will win at the same time as the software will win. Fourth quarter operating earnings per share coming in well ahead of expectations. So they've got that control on costs as well, Romain.
I am curious here, and maybe you could kind of put this in broader perspective. You cover this stuff every day. We're still awaiting Meta, and I wonder if you could kind of push ahead to that. Meta basically pre-announced. It kind of told us about their AI cap spend, so maybe the market reaction won't be as severe. But when I look at the numbers out of Microsoft, these aren't awful numbers. I mean, these are minor misses. Similar story with IBM. Obviously, Tesla's a whole different bag for a lot of reasons. What do you want to see out of Meta?
I think people want to see that the return on AI is actually here for the advertising offering. This is where people have been excited about what already has been integrated, that you and I are using Meta AI products as a consumer, but that the marketers are using it in terms of precision advertising. They're able to therefore charge you more for your advertising, and therefore these open source llama competition coming from DeepSeek, but maybe they use DeepSeek and suddenly the efficiencies there longer term to be able to drive yet better and more efficient AI offerings.
Have you tried to download DeepSeek?
I did, and I couldn't get in there.
Yeah, I tried.
I
tried too. Yeah,
yeah, exactly. Wrong number, wrong time. Should have been in there on Friday night. And otherwise, is it still working for those that have it downloaded on their phone in terms of the cloud computing that they're going to be offering? But they really are trying to see whether.
And I should point out, I've tried to download that. I could not download TikTok, by the way. Yeah.
Well, you should have seen where the ban came.
Have you seen how expensive phones with it pre-downloaded are on eBay at the moment? You can go and get yourself a very expensive iPhone that's already got TikTok. Come and look at my feed.
Only if he was 13 years old. In terms of Meta, I guess the big question here is about the consumer products that rely on these AI features and the breakthrough that DeepSeek achieved. I mean, do we start to see that pay off in terms of consumer products with those glasses that our producers walk around with the chatbots that people actually interact with at this point?
Certainly. I think actually that'll be interesting that we're going to hear about the reorganization of Reality Labs. You talk about how we slightly pre-announced. There have been a lot of reporting around Reality Labs, slightly getting reorganized among different COOs and which parts of the business are going to be spending there. But I do think they've managed to integrate generative AI across their products already, and that's why these shares have outperformed. In last year, 15% up this year as well. Meta has managed to prove itself that, yes, you're getting return on AI investment already. Yes, it's going to be big, $65 billion. Stick with us. We've got the open source integration. We're already leading on that front. He's going to have to speak a lot about why, though, DeepSeek isn't a massive competitor to him, but instead vindicates his large language model operation that is open source.
Yeah, even complementary, perhaps. All right, Caroline Hyde of Bloomberg Technology, thank you so much joining us with her instant analysis of the big earnings out of Meta, out of Microsoft, out of Tesla, and of course out of IBM as well. Romain? ServiceNow also crossing the wire. Another AI story, a miss on subscription revenue, sending the shares lower here in the after-hours trade. Top and bottom line numbers were relatively in line, but that subscription miss both in the most recent quarter and the forecast going forward for the full year, $12.64 billion to $12.68 billion. The street was looking for about $12.87 billion. This despite the company saying that it has expanded its partnerships in the AI space with Google and Oracle, and also says that all the development costs with regards to DeepSeek and other things could actually benefit that company as costs go down. Scarlett. Yeah, as many analysts have already indicated, and we did see the stock rise on Monday trade as a result. All right, let's get some more perspective from an investor on some of the big tech earnings that have crossed. We want to bring in now Ross Gerber. He is co-founder and president and CEO of Gerber Kawasaki. Ross, always a pleasure to speak with you. I know that you look at Tesla very carefully, and the results are out, and I know that the stock has moved independent of what the company has told us about its the sales of its EVs. But I do want to get your take on the gross margin number that came in for the fourth quarter. Automotive gross margin, when you back out the regulatory credit, was 13.6%. Is this enough to move the stock in for those who are fundamentally focused on Tesla?
Well, I think this is actually a bad number, right? I mean, gross margins continue to decline even after all the layoffs and stuff last quarter where they got the benefit of higher margins. Because of that, now margins are continuing to decline because they're having trouble selling cars for obvious reasons. And so, it's really a game for Tesla of like, they can manufacture actually a lot more cars than they're selling, so they just hold back, and then they have to do pretty much every demand lever possible to get rid of the vehicles. And so we're seeing it in the numbers. And once again, I'm not surprised by it. They don't advertise, and the only advertising they have is Elon.
Right. Well, he's a pretty effective advertiser, we got to say. Ross,
not for cars.
Not for cars,
truck.
for other things. Yes. Well, I mean, at some point, does the tide turn on Elon Musk and the gains that we've seen in the stock, up 55% since the election, up 83% since the last earnings, start to drive down the stock in a way that's, again, divorced from fundamentals of the vehicle business?
Well, once again, the stock is actually down over the last 3 years. So when you look at it from 3 years ago, we haven't made any money in Tesla. And at that point, they were expected to do $4 in earnings, and it traded at 100 times earnings in 2021. So we were at $400 a share. Today, we're at $376 a share with $2.46 in earnings. So when you actually look at Tesla's financial performance over the last 3 years, it's been horrible. And so this is a growth company at a huge multiple that isn't growing. So what's going to get it to grow? That's the big question.
Well, I am curious, just beyond just building cars. I mean, there was this whole narrative, or at least really a whole model into the thesis, the bull market thesis of Tesla, that it was more than just a car company, that some of the technology components, AI, autonomous driving, blah, 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 all this sort of is what gave it such a higher valuation relative to a GM or Ford. It was a tech company. Is it still a tech company? And if so, when can we see them actually leverage some of that into real growth?
I mean, there's no question that it's a tech company in the sense of its focus really is on software and developing software for robots and autonomous vehicles. But their core business is selling cars and energy storage and charging. And that's what Tesla was founded. His mission is to advance sustainable transportation and energy, and that they were doing a wonderful job before they pivoted into a bunch of businesses that we're not sure how they're going to be, which is robotics and cybercabs. So, and that's not coming anytime soon either. So I just come kind of like asking the question of like, where does the growth come from over the next several years until these technologies work? I use full self-driving every day, and now I see Waymos every day all around me driving perfectly fine, and my car still can't do it. So I don't care how many times Elon says that it's going to work this year, and this is the year of full self-driving. It's just a bunch of crap at this point. It doesn't work. It still doesn't work. So it works pretty good. I like it. But it's driver assist. That's where we're at still.
That is where we're at. I am curious, Ross, and I do just want to pivot a little bit to the broader tech space. I mean, we are getting Microsoft earnings right now. Obviously, there's a big talk about AI spend, a headline crossing the terminal now, saying that they continue to boost that CapEx spending in the coming years. When you look at tech leadership overall, who is that leader? Or who do you want to see be that leader?
Well, in my mind, it's clearly NVIDIA. I mean, NVIDIA is the tech leader of all tech leaders, and Jensen is, just a monster when it comes to business and his ambition and the way that AI infrastructure needs to be built. NVIDIA is just a core player in this infrastructure, and it doesn't matter how many BS Chinese apps they release, it's not going to change the need for a massive amount of compute to upgrade the computer systems that we have today, including Tesla's, where it still just doesn't work. Siri still doesn't work. Essentially most intelligent, computing that we consider intelligent today doesn't really work very well. So there's so much opportunity for an increase in productivity through these investments. So NVIDIA is the leader, and then I'd say seconded by Microsoft, where I thought their numbers were really good this quarter. I haven't parsed through every one, but we have really high valuations and really high expectations in the stock market today. And that's why we're seeing the sell-offs after earnings, is because, you're seeing these companies trade at multiples that are historically quite high. So I wouldn't be concerned about these big moves of volatility in these names because the valuations are so high. You should expect that.
Yeah, so it feels like we're primed for some kind of a pullback in the market given the valuations, and DeepSeek just kind of provided a convenient excuse to do that.
Right, exactly. And I don't think that that's a bad thing. This is like part of a bull market, is you want to have these periods of time of consolidation and pullbacks so that, investors like me can take advantage of them, but also just, the worst thing you can have in the stock market is one that just goes straight up, because what happens is it eventually goes straight down. And so, bull markets ultimately have corrections, and that's just part of it. And we're clearly in a bull market, and, the Fed has a lot of ammunition to lower rates in the future. future if the economy slows. So we're really in a good spot for investors. But when you're buying stocks like Microsoft at 30 and 40 times earnings, you're going to have volatility. There's not a lot of values in the stock market today in the technology sector. There's only a few names that I could name that seem cheap to me, like Dell. But the rest, it's premium prices because these are premium companies.
Absolutely. Ross Gerber, founder, president, and CEO over at Gerber Kawasaki. Tesla shares lower in the after-hours trade after falling short of Wall Street estimates in the most recent quarter. Microsoft shares also moving lower because of some disappointing numbers. We should point out the CapEx spend was actually lower than what the street was expecting, but some of those margin numbers causing some concern, and now Microsoft saying that it does plan to increase that CapEx spend in the years to come. Rishi Jaluria joining us right now, managing director covering software equity research at RBC Capital Markets. And Rishi, what was your main takeaway from this earnings release out of Microsoft?
Yeah, again, thanks so much for having me. Look, my biggest takeaway out of this is Microsoft kind of continues to execute in line with expectations. We can go through all the numbers and say, okay, well, Azure was maybe a couple, maybe 50 basis points light of expectations. CapEx was maybe a little bit higher. EPS obviously beat. Over the overall, though, I would say numbers were very in line with what we expected, where I think the market is pricing things in. As always with Microsoft, I think it comes down to the actual guidance that we get from Satya and Amy on the call, right? I mean, they pointed to strong bookings with OpenAI. The commercial RPO number was really solid. And so the question becomes, can they reiterate that Azure back half acceleration that they've been talking about as more first-party capacity comes online? And I think as long as they do that, the stock can be fine coming out of the earnings report.
Yeah, we'd be remiss in not pointing out we're still talking about, at least on the Azure side, basically a 30% growth rate here for a company that mature and of that size. That is phenomenal. But Rishi, the big question is, when do we get to the point, or when should investors, if at all, get to the point where they should start to worry about, I guess, kind of tapping out? I mean, have they sort of reached what they can reach, or is there more of a market out there for them to take?
Yeah, I think there's such a huge market opportunity there. Even let's put AI aside for a second. Even if we just think about overall cloud penetration, we're still in probably early middle innings when it comes to that. There's a lot of on-premise that needs to migrate to the cloud as you get companies migrating to the cloud, adopting adjacent services like Microsoft Fabric, Cosmos DB, Azure, Synapse. And I think that drives the overall cloud growth number up as well. And then you layer on AI into this, and if we're in early middle innings when it comes to the cloud, we're in maybe the top of the first inning in baseball terms when it comes to AI. I know we've been talking about this for so long, but as this technology continues to evolve, as the cost curve comes down, and most importantly, as new use cases come about, I think Microsoft is well positioned to capture this. I think they're in a league of their own when it comes to AI, at least when it comes to software.
Yeah, but DeepSeek certainly questioned a lot of the foundational assumptions that investors had come in with. And we know that Satya Nadella praised the DeepSeek technology, as did others. Will the company need to change the pricing of Copilot and its other AI offerings now that DeepSeek has proven that it can do the same thing, but on a cheaper basis?
Yeah, I mean, there's a lot of open-ended questions around DeepSeek in terms of how is the technology actually developed? How real is that $5.5 or $5.6 million numbers? But let's put that aside for a second. Overall, the cost curve coming down is a good thing for Microsoft, right? There's the element of the OpenAI relationship and training, but ultimately, anything that drives the cost of Gen AI, inferencing, fine-tuning, reasoning down is good for software because it means that you get greater volumes, you lower barriers to entry, and you create this flywheel effect whereby the more people use these Gen AI offerings, the more the innovation, the more those net new use cases come about. And remember with Microsoft, even though they're closely aligned with OpenAI, and we continue to expect it to go in that direction, architecturally, things like GitHub Copilot, Office Copilot are architected to be LLM neutral. So it doesn't have to be OpenAI powering that. You as a customer can choose which LLM you want behind the scenes.
Rishi, you have an outperform rating on Microsoft with a $500 price target, so you're clearly bullish on it. But Ross Gerber, who we just spoke to, called some of these big tech companies premium prices for premium companies. Is there a discount price for a discount company in this same space that competes with Microsoft that might be a better bet right now if you don't want to start a position in Microsoft?
Yeah, if I kind of think across my universe, there unfortunately aren't too many companies that have GAAP earnings to the level of Microsoft that are positioned in AI. One that I would actually call out is probably Intuit. If we really think about the AI adoption curve, it starts at consumer before it goes to SMB and then the larger enterprises. And Intuit is squarely in the consumer and SMB space. So we think Intuit is well positioned, especially if we think about generative AI disrupting these services intensive industries like tax prep and accounting. So that's one I would keep my eyes on.
So give us a sense here, Rishi, when we start to see this, with the CEO come on and articulate the longer term vision, are we making too much of the AI portion of this? And I know it kind of all folds into cloud, but there has to be a separation between how this company was performing before all the AI hype and, of course, what's transpired over the last couple of years.
Yeah, and we definitely think about it in that manner, but I think this will start to get more and more interlinked as time goes on. We've used this phrase before, the AI halo effect, where because of Microsoft's leadership position, which again we feel is underappreciated by the investment community today, but customers understand that drives adoption of other areas of Microsoft, those adjacent services, especially Microsoft Fabric within Azure, but even Office, and that allows them to be share gainers in the entire space. So we really think, they kind of feed really well into each other, where AI can be cross-sold into the existing Microsoft base. And as Microsoft lands net new logos with AI, they can cross-sell the rest of their portfolio. That's why we think Microsoft is so well positioned, because it is a giant portfolio company with kind of weapons in every area.
We should mention that Microsoft has pared some of its losses in after-hours trading and is now down about 1.2%. As compared to the previous open, currently down about 1% in after-hours trading. Rishi, what will you be listening for? What do you want to hear from Satya Nadella during today's conference call?
Yeah, I think there's three things I want to hear from Satya and Amy. Number one is just a reiteration of that acceleration in Azure in the back half of the year. I think that's what investors are looking for, and we want to see first-party capacity coming online and being able to meet all that AI demand out there. Number two is I definitely want to hear a reiteration of what Satya said on Monday, which is ultimately driving down the cost is good for Microsoft, it's good for software, and it's ultimately good for customers. And number three, really understanding the multimodality of Microsoft, that, again, they're tied to OpenAI. OpenAI is the most innovative company in this space, but Microsoft has their options open as the technological landscape changes, and they are well positioned no matter how this evolves.
All right, Rishi Jaluria, Managing Director covering software equity research at RBC Capital Markets, giving us his analysis on Microsoft. Thank you so much.
And of course, there's been so much talk here about how these companies are benefiting from AI. We had results out of service. Now, of course, one of the biggest cloud software providers here that has really sort of dove deep into agentic AI, not getting a bump from that, at least on the revenue side. You're seeing the shares move lower here in the after-hours trade. I had a chance to catch up with the CEO, Bill McDermott, just a little while ago, and he's still pretty bullish on the future, talking about the idea that what we learned from DeepSeek actually could be a net positive for companies like his, of course, as they are on the take side of those costs. So as those costs come down, that could benefit. But more importantly, he talked about, Scarlett, this broader idea here of how he continues to see heavy AI spend, but it will shift from hardware and infrastructure to what he says is agentic AI, which of course is his business. And he asked, you said, and I'm using his words here, he talks about this idea here that he has never really seen this type of sort of technology transformation. He's been around for a long time. Remember, he ran SAP. He was there for the dot-com bubble, the edge of the internet. He says an unbelievable hockey stick of innovation coming out of this here. And he says this is the first time that we've seen, quote, global alignment of a dream like this. Yeah,
pretty incredible. Yeah. But nevertheless, you look at the stock price right now, down about 10% in after-hours trading, and you just look at the valuation. The stock trades at 161 times reported earnings, 68 times estimated earnings. So, that gives you a sense. Again, I go back to what Ross Gerber was saying, premium pricing for premium companies, and you're kind of seeing that take place. The subscription revenue outlook did disappoint investors who, of course, have come to expect big things.
Yeah.
All right, let's take a look at shares of Meta as well, because we are awaiting those results, and they have not come out yet. Typically, they come out around 4:16 p.m. New York time, and that's the latest they've ever reported, according to Bloomberg data, and it looks like we are well past that right now. So let's bring in Shweta Khajuria, Managing Director who covers global internet at Wolfe Research. Shweta, it's good to speak with you. When it comes to Meta, this has been by far the big winner among the Mag 7 names so far this year, up about 15%, and this is very much on on this idea that it has managed to fold AI into its core business, into its digital ad business, better than some of the other companies. What are we likely to hear from this company, given the disappointments that we've gotten so far from big tech companies and the fact that expectations are so high right now?
Well, first of all, thanks for having me. And it is unusual that they have not reported yet, and we are 30 minutes past the close almost. I guess there will be three things that will be top of mind for everybody. One is obviously the cost efficiency gains that they could potentially realize now that we have an example in DeepSeek, which is also an open weight model, just like Llama, and their R1 launch, which I believe everybody at Meta knew, and it has been known in the market. It's just that can Meta also realize those types of cost reductions and efficiency gains in their models? The second thing is that the platform changes that Meta made around censorship and also fact checking, will that impact advertising revenue, and how has that impacted their engagement overall? And then the third thing is overall their CapEx trajectory. That is not only the 60 to 65 billion in guidance that they pre-announced, but what can we make out of that in terms of what about 26 or 27? They may not guide, but they could at least provide some commentary on it.
Right. And of course, that $60 to $65 billion of CapEx was pre-announced well before the DeepSeek news. The operating expenses is going to be a big question mark for a lot of people. And I'm glad that you bring up the fact that it will no longer be fact checking. Won't that be something that is a benefit when it comes to the expenses that it is putting out there for operations?
Absolutely, and I should have mentioned that OPEX and CapEx. Now, this while the street's looking for approximately 110 to 111 million in annual total expenses guide, I think that investors are bracing for a higher cost guide of around 117 million at the high end. So I guess the question is going to be around headcount growth as well. What are they thinking about headcount? They were laying off some people based on performance, but planning to backfill those roles. In addition to that, they're planning to perhaps grow headcount for AI roles, and what their plans are around that will be key focus area as well, in addition to the CapEx and the related D&A costs that are baked into the OPEX number.
All right, Shweta Khajuria, stand by, because we are still awaiting those Meta results. They are late in publishing those results, but we do want to bring in our next guest. Romain?
All right, Kristin Roth DeClark joining us right now over at Barclays. Great to have you here. And I know you can't talk specifically about the earnings, but we do want to get your kind of broader take here on just kind of investment in this space. I mean, we came, I was going to say into this year, but really we came into like 2023, 2024 with kind of this huge interest right now in tech investments, particularly in the AI space. And I'm wondering if anything has really changed, given what we learned 72 hours ago out of DeepSeek and all of the market reactions to it.
It's been a really busy week of AI announcements, and at the end of the day, this is a new technology, relatively speaking, and we are in the early days of innovation. And actually, I think that the competitive landscape really does fuel innovation. So we're going to continue to see companies compete to be faster, more efficient, more cost-effective, and that's going to continue.
Where do you find opportunities? Because we talk about this with this kind of this big umbrella of AI and things, and we kind of forget that there's so many different segments to this. And I am curious as to where you find opportunities in this space that maybe differentiates, I guess, what you and your team does from others.
Yeah, maybe let me comment for a second on some of the recent news. So I think that the models that are coming out that are efficient, more cost-effective, and will solve sometimes smaller problems. I think we're going to continue to see a landscape of AI models, from the highly complex, large models that are highly secure to ones that are more broadly deployed and accessible, that are cheaper and more efficient. And so that's what we're hearing about this week. I think we'll continue to hear different applications and continue to see the infrastructure investment from companies, from municipalities continue.
What kind of themes are you looking to really focus on and hope to learn from when you hear the earnings reports from these big tech companies, especially as it relates to their appetite for deal making?
Yeah, I think we'll continue to see the investment in CapEx. I know that's what you were talking about with one of the earlier guests. I think we'll continue to see that, whether it relates to the large models or continuing to move towards some of these smaller, highly specialized, more efficient models. That is one piece of it. And then I think, looking to companies, looking for an increased appetite from the regulatory standpoint for deal combinations and business combinations. I think the M&A environment will continue to pick up. Last year, we saw an increase in tech M&A volume by number of deals of 35%, but the dollar value was down 15%. This year could be the return of mega tech M&A.
Okay, we keep saying it could be the return. You know, we're well positioned for that. Is the change in government personnel, whether it's at regulators, at the FTC, at the DOJ, sufficient to give companies the green light to go ahead and pursue deals? Or is everyone still waiting for specific measures to be taken at this point?
I think there's a little bit of detail that's still required, I think, to give companies confidence to actually launch into some of these big business combinations. But those conversations have increased in a meaningful way, at least from our side, over the last, post the election, so over the last 4 months or so around big deals.
How much appetite do you think there could be for cross-border deals, given some of the rhetoric out of the administration? And I say that against the backdrop, because when we talk about AI and some of these investments in technology infrastructure, there are a lot of foreign companies that have something to offer. Would there ever be an appetite or maybe an allowance for those companies to actually pair up with ours?
It's a great question. I was in Davos last week, and a lot of the conversation was around cross-border M&A and regulatory environment. And if the U.S. does have a less strict regulatory environment for M&A, is Europe soon to follow? And what happens with Europe in order to as a continent to remain competitive in technology? And it could be things like the EU coming together more and increased spend around innovation. But a big part of that is going to be deregulation.
Then on that same note, though, I mean, what did you hear from foreign, meaning non-U.S. investors wanting to be a part of what's happening here in the U.S.?
Yeah, I think we'll continue to see that. I mean, given the growth that's happening in AI in particular in the U.S., we're continuing to see foreign investment coming in.
When we talk about M&A in the tech sector, how much of it is defensive versus offensive? Companies kind of making sure that they don't get swept under versus those that are really looking to gain their market share, build out their market share even more?
It's both. In most cases, it's kind of what can we do to continue to accelerate innovation. On the defensive side, activism remains a really real threat and a catalyst, honestly, for M&A in the tech world. I think 10% of the market last year of public companies had some sort of activist. And so we'll continue to see that. And that will fuel M&A, it'll fuel divestitures, some spin-outs, subsidiary splits, and so we'll see more activity, I think.
Why do you think we saw that uptick in activist investments? Was there something that spurred that?
Honestly, part of it's just any movement in execution or any failure in execution or changes that have happened over the last couple of years have just had increased scrutiny, I think, for investors. And it's hard to find, the growth assets in the market right now are limited. There's a lot more focus on profitability and efficiencies, and if companies aren't getting there quickly, then you see activists come in.
And we should point out, Scarlett, we didn't have a chance to break this because of all the other news, but Penn Entertainment getting its own activist investor, HG4, launching a proxy fight for the board there.
Well, join the club. Yeah. Well, with the focus on profitability and efficiency, does that mean there are going to be fewer companies trying to go public because they're not in a position yet in terms of the profitability to really impress investors and get that premium?
Actually, I think the first companies to come public in the tech space will be more private equity backed, so larger cap, super profitable businesses that have been sitting inside private equity firms for 4, 5, 6, 7 years and waiting. And actually, with the market being healthy, look, of the tech IPOs last year, while there were only 7, performed on average up 40%, which beats the overall average of IPOs and the market. And so there is a bid for it from the investor side, and now it's kind of been long enough, and it's time to start showing a monetization for a lot of these PE-backed businesses.
I'm just going to play the devil's advocate. Suppose the market doesn't hold up, and I know it's a big what if here. Are those private capital guys, are they still willing to be patient if for some reason market conditions over the next few months aren't necessarily conducive to bringing those companies public?
The beauty of taking a company public versus selling it is that you're only really selling, in some cases, 10% of the overall size of the business. And then you have kind of 2.5, 3 years typically to monetize it in the public market. So you don't have to get the last dollar at the time of the IPO. So I do think we will see some of these really steady growth, super profitable businesses come public. I think there will continue to be a bid. There's been a bid for these companies over the last couple of years, and now there actually just is the willingness from the other side to start to monetize them and to show a public mark.
All right, things are moving in the pipeline then. Kristin DeClark, Global Head of Technology Investment Banking over at Barclays. Thank you so much for joining us today.
Thank you.
It feels like a million hours ago, but the market did close, and it closed lower. And this was all before the wave of big tech earnings remained, because there was a Fed announcement. They didn't say very much, but there was a Fed announcement.
There was a Fed announcement here, and of course the market now really much more focused on earnings. It's kind of interesting. We're waiting on Meta. That was going to be one of the stars of the show, coming a little bit later than expected.
Could still be.
But I just want to point out too in the after-hours trade, because there are a lot of stocks moving here that are going to have a big impact tomorrow. And of course, some of these names we didn't have a chance to break because we kind of got overtaken by Microsoft, Tesla. But you have Whirlpool down 12%, ServiceNow down 9%, Levi Strauss down 5%, but then to the upside, you have names like Las Vegas Sands up about 8%. IBM, which initially kind of was weak when their earnings first came out, now up 8% in after-hours trade. And I do kind of wonder, when you talk about this newfangled tech with AI, and then you see, 80-year-old Larry Ellison in the White House, are the old tech companies back now?
It feels like it, right? Yeah. Legacy tech has found a way to get back into the AI game. And, for a name like IBM, it's really based on software. And shifting some of those customers into these recurring revenue streams and making sure that they can capitalize on that.
And it's about reliability, too. I was talking to somebody last week about the Oracle thing, and he was saying that this was a big part of it. It's like sometimes when you're spending this amount of money and you're having to move so fast, who are you going to take a chance on? A new, somewhat untested company, or a player like Oracle or IBM that's been doing this for decades?
Right, a company with a reputation that continues to serve its customer, right?
We are awaiting those earnings out of Meta. I think we need to take
Meta earnings crossing
the wire right now. Let's get right to it here. Meta revenue in the most recent quarter coming in at $46.78 billion. That is a beat. The street was looking for $45.6. On the EPS side, wow, $8.02 a share. The street was looking for $6.78. Operating income also a beat here. And here's your guidance here. The company's saying that for the current quarter, the first quarter, it sees revenue of $39.5 billion to $41.8 billion. The street was looking for 41.6. So the top end of that range, kind of on the nose of what the street was looking for, though down at the bottom here, that could be a little bit lower. Here's your CapEx number, which the company did pre-announce. 2025 CapEx, Scarlett, 60 to 65 billion. Street was looking for 52.4.
So that outlook for the revenue for the first quarter, the midpoint of the range that it offered is about 40.65 billion. That is lower than the consensus estimate of 41.67 billion. So that might be one reason why the stock is down 4.2% in after-hours trading. Of course, there's a lot of factors as well. Meta also says they're not providing a full year 2025 revenue guidance as well. So no full year outlook. They're only giving that first quarter outlook. And the guidance assumes that foreign currency is is at about a 3% headwind. So the strong U.S. dollar continues to be something we look at, a headwind here for these big multinationals.
The company talking about the regulatory landscape, the company also talking about the cost of its employees and expects employee comp to be its second largest factor in its expenses here. So this is a company, of course, that is spending a lot of money. Of course, they are generating a lot of cash flow as well. The question is, when you look at that valuation, you look at where the run-up in the stock has gone, does that spending and the overlay with revenue make sense?
All right, let's bring back Shweta Khajuria, Managing Director who covers global internet at Wolfe Research. And Shweta, it is unusual, as we've been saying, for Meta to wait this long to report earnings, but we did get first quarter revenue guidance where the midpoint of the range it offers trails the average analyst estimate, and it will no longer offer a full year revenue guidance. What does that tell you? That combined with the fact that the earnings came out a little bit late, what does this all add up to?
Well, I'm not sure what to make of the late earnings release. There could have been a technical glitch for all we know. But in terms of the numbers itself, for Q1 guidance, it came below the street estimates, but investors were expecting something around 40 to 42 billion, so modestly lower than what it actually seems, is my understanding. Expectations were lower than where the street was. And then also for the full year guide, they gave 114 to 119 million. And as I was just saying a few minutes ago, investors were bracing for up to 117 million or so at the high end in terms of the OPEX guide, even though the street is looking for about 111 million. So maybe modestly worse than what investors were looking for, not meaningfully. And I'm not surprised that the stock is down in the after hours because it has had such a run up over the past few days.
Yeah,
it's giving back the gains.
And to that point, just reiterating what Romain was saying earlier, Meta expects employee compensation to be the second largest factor when it comes to expenses. So that total expenses coming in higher than anticipated, a lot of that is on talent. We also have another headline here about how Meta says the majority of the 2025 CapEx will be directed at its core business. Given that we know it's going to spend $60 to $65 billion, what kinds of questions does that raise for you?
Well, number one is where within the core business are they actually spending? Towards what? Is it towards driving engagement? Is it towards Meta AI? Is it towards purely just hiring folks? Where is that spend actually targeted towards? And how are they measuring the ROI? I know that the company is very ROI focused, but what can they tell us that helps us figure out, okay, well, they are making progress and then that there is ROI and improving ROI on a go-forward basis?
I am curious, too, and we should point out as we're speaking to you, of course, about some of the changes that Meta is making in some of its employee costs. Another headline on Microsoft saying that they plan to add jobs in the infrastructure, Gen AI, and Reality Labs. But it gets to a broader question, and Shweta, and this is really about the amount of money that these companies are spending, and when we really, not so much the return for them, but ever the return for their end users, because ultimately that's going to be the big determinant of how long this continues to go on. And I know there's a difference between some of the enterprise spend and some of the consumer-facing stuff here. But do you see a light at the end of the tunnel here where we are going to see greater adoption of this and, more importantly, people paying money for this?
I do see light at the end of the tunnel, and I think that we may be coming very close just because DeepSeek is an example of them making it work with much lower cost. And so we kind of have an example of that with an open weight model. So I would be very surprised if Meta continues to invest in CapEx at this trajectory, going from 40 billion in 24 to 60 to 65 billion. I highly doubt it's going to be that type of a growth rate in 26 and 27. So we should expect deceleration on that front. And on the user experience side, which was the first part of your question or your comment, we are seeing improvement in terms of time spent. There are only so many billion people on Earth, and they have over 3 billion people on their apps, but the time spent is growing for them, and that implies that engagement is growing, and the product changes that they're making around targeting and making it more engaging around video, for example, they seem to be working for them. So as long as that happens, the implication is that the ROI for advertisers is improving, and pricing of that ad per impression should hold up, and that drives revenue. My final point is that the revenue growth is still in mid-teens for a business this big. And so the question is also, with 70% penetration of digital advertising, can this company at this scale continue to grow in mid-teens? These are big numbers. And we think that they can, because search is another bucket where they could be gaining share from on a go-forward basis.
I just want to make a quick correction here. I said Microsoft had said that they were going to add infrastructure Gen I. I should have said Meta. We've corrected that on the Bloomberg terminal. Meta to add infrastructure Gen I and Reality Labs jobs. I think it's going to be our final question, and it's more about the leadership right now at Meta. Of course, Zuckerberg's been at the helm since the inception of this company. Obviously, he's still relatively young. I am curious as to how confident investors should be in his stewardship, particularly given some of the pivots in recent years to metaverse and now obviously a big push and a lot spend in the AI space, excuse me.
Well, to Mark Zuckerberg's credit, he has taken a lot of steps to earn the credibility as well as respect from investor community, at least from our viewpoint. Whether it is pulling back on OPEX, it's the year of efficiency, it is shifting the focus from reality, not complete focus, but shifting gears a little bit or a lot to AI from Reality Labs. All the changes that they have made are arguably have worked really well, and we're seeing that in the stock price being reflected. So I'm not sure if the investment community really wants him to leave the platform, because he's done a phenomenal job. Within Meta, I can see some changes on the leadership front, and we actually did hear from them on Reality Labs, where now Javier Olivan is going to be taking charge at Reality Labs, and Dan Reed will be stepping away. So that those types of changes I can see, but I don't see Mark Zuckerberg leaving.
All right, Shweta, appreciate you taking time. We'll let you get to that conference
Thanks
call.
for having me.
Shweta Khajuria, Managing Director, covering global internet at Wolfe Research. A closer look at Meta, Microsoft, Tesla, a lot of the big players in the AI space, and with all of the hullabaloo, of course, around the spending that they're doing and whatever the heck DeepSeek is doing, there are still some big questions about, well, does this stuff actually work? Does it do what it's intended to do? Our next guest left Google back in 2020 amid concerns about the company's ethics on AI. I'm pleased to say that Timnit Gebru is joining us right now. She's a founder and executive director of the Distributed Artificial Intelligence Institute. And of course, one of the most influential research papers on large language models, and more importantly, on the reliability of them, was published by her a few years ago. Timnit, thanks for being here. And I know we get so caught up on this show about the promise of AI and these models, whether we're talking about the institutional stuff, the forward-facing consumer stuff. I don't know how good this stuff is. And you left Google primarily because you raised questions about the type of data that was going into it and whether we were getting something reliable out of it or just garbage. Has anything changed in the last 4 or 5 years since you left?
No, I don't blame you for not knowing whether these things work or not. What is the hype? What's reality? Because I think that the academics who should be informing the public are really not doing their jobs, right? And academics should be making claims that are substantiated. But on the other hand, we see things like even with DeepSeek, there are claims about reasoning capabilities where we're not sure, actually. Some of these benchmarks, people have shown that it's unclear if a particular high performance on a particular benchmark actually means that these models are doing reasoning, right? So there are a lot of misleading claims currently. But the only thing that has changed is that every single one of the warnings we had in our Stochastic Parrots paper, which is why I was fired from Google, have come true. We are now seeing these companies saying that abandoning their carbon neutrality goals and now talking about actually going into nuclear power, right? Yeah. We are talking about all these investors are saying that there should be no copyright restrictions because I believe it was Mark Andreessen saying something akin to the entire human corpus needs to be used to train these models. Yeah. And I'm asking the same exact question that I asked back then, which is, why are we going for size? Why do we need the largest models? Why do we need the largest and most number of GPUs, the biggest data? Yeah, well, the answer to that is money. You know that, Timnit. But in all seriousness, I mean, you mentioned stochastic parrots. I can't even say that phrase, but that kind of refers to this idea that these models are maybe good at basically parroting what's out there, not necessarily interpreting it, comprehending it, and so forth. You mentioned you being fired, or you characterized it as being fired. You weren't the only sort of person in that position, meaning in the broader tech space, to leave around that time. And I do wonder who's watching the store. OpenAI got rid of a lot of its ethicists. A lot of other companies got rid of their ethicists. There, at least as of today, does not appear there's going to be any formal government regulation in the United States. So who's keeping an eye on this? It's unfortunate because I think it's almost like I sometimes say that I'm learning about how propaganda works because it's kind of a fear of missing out. Everybody wants to be in on the race rather than kind of taking a step back and critically thinking about what claims are actually true versus not, and whether or not the path that we're taking is actually good for innovation. For me, one of the things that got me excited about computer science was this idea, this challenge that what we think about is how to minimize resources. How can you do a particular task with minimal amount of memory, with minimal amount of energy use, etc., right? We take all classes and do research in that area. Whereas the current paradigm seems to be, if we assume that we have unlimited resources, whether it is GPUs or data or anything, what can we achieve? Which is a less interesting question. And that also leaves out a lot of people who don't have the means to contribute to this research. But now we see with DeepSeek, it remains to be seen the extent to which their claims on lower costs for training, for example, are true because they only give us part of the story, which is important to note. But it also says that, when you innovate more under constraints, and it's more interesting to think about how minimal of resources can I use to achieve a particular task, which is the research I'm interested in personally.
That's an interesting way of looking at it. And I'm glad you bring up your experience with computer science classes and kind of the ethos driving that. Do you think these big tech companies that we spend so much time covering and all the money, the hundreds of billions of dollars that they're spending to build out AI data centers, are they using a ton of resources, money, energy because they can? And that's the simple reason?
So the question I asked when I was at Google is literally because they were fixated on building the largest models, and it was unclear why. And at the time, it was because OpenAI had the largest models. So to me, if you want to go for the largest size of any kind, it has to come with the task. What do you think you will achieve with the largest model? And unfortunately, there are all of these pseudo laws. They're not necessarily scientific. So people say scaling laws, but scaling law is not a law like the law of gravity that you model and prove. And there's all of these words that are used, like emergence, assuming that a model has all of a sudden learned certain capabilities that it wasn't trained for. Once again, not scientific terms. So unfortunately, I think that this is where scientists and academics could have done a better job of grounding the public in what reality is. And so because we're not doing that, it's very hard to understand what really the capabilities are. And I do believe that it's a race to the bottom. That if OpenAI says that they've used 10,000 GPUs, Elon Musk has to say we're now going to use 100,000 GPUs. Right. And no one can win that race, really, even with unlimited resources. So final question to you from me. Bottom line, when you talk about DeepSeek and you think about it, what is the single most important issue that the emergence of DeepSeek raises from an AI safety perspective? I think that, to me personally, the single issue that it raises is kind of uncovering what the hype, kind of debunking the idea that you need the largest everything, the most expensive things, unlimited data, unlimited resources in order to create certain kinds of models. However, what worries me is that this is further going to be used to say that the U.S. has to win the race against China, and therefore companies in the U.S. should face absolutely no restrictions, which means more data theft, and also absolutely no oversight into what these models are producing.
All right, team, I really appreciate you taking time for us. So one of the best minds in science, one of the best minds in AI, Dr. Timnit Gebru, founder and executive director of the Distributed Artificial Intelligence Institute on a day, Scarlett, where we had a lot of tech earnings, and those earnings were all about AI, but a kind of a divergence here. It's kind of interesting. You're seeing NVIDIA up. They didn't report today, but they're getting a boost. IBM reported they're getting a boost, and Tesla up as well after being down earlier in the session. Right, but I mean, all of this could change once the earnings calls really begin in earnest and we start to hear some of the questions that are posed to the CEOs and, get to the nub of, how that CapEx is being distributed. And we get the divergence here. You flip up the board and you take a look at the software companies, the ones who are doing much more of that spend, basically buying the picks and shovels, if you will. Microsoft down and leading a lot of the other software companies lower. ServiceNow also reported moving lower. And you take a look at Atlassian and Salesforce also drifting lower here in the after hours trade. Yeah, and of course, Salesforce and ServiceNow were seen as beneficiaries of DeepSeek and the cheaper, more efficient AI models out there. All right, we appreciate you joining us here on The Close. We'll be back tomorrow with more earnings. Remember, Apple reports after the bell. Full coverage, better than no one else, right here on Bloomberg.